So let's have a look on how we have to calculate the net present value of a project. It basically consists of two components. One are the cash flows. You see cash flow at the beginning, cash flow in year 1, year 2, and year 3. And the other component is the discount rate, which is the WACC. But let's start by calculating the cash flows. To calculate the cash flows, again, there are two components. One, so first we're going to calculate the accounting numbers, and the only reason we do that is to know the tax consequences of the project. After we know the tax consequences and the after-tax earnings, we're going to adjust those to obtain the actual cash movements, right? So let's start with the accounting movements. Say in year 1 we have 100 revenue, and then every year it's gonna increase with 10%. Okay. Cost of sales are 50, and then 51 and 52. Right, so this will all be given in the exercise. Let's say the rent is constant of 5. Salaries of 8, let's say it goes up a little bit, 8, 9, 10. And then for the depreciation, let's assume that the company is gonna buy or has to buy a machine that's worth 90, and it's gonna depreciate it over the years of the project, so over 3 years. So 90 over 3 years, that means they're gonna depreciate 30 every year, right? And the residual value of the machine is 10. So at the end of the project, we assume that we're going to sell the machine for 10. Okay, so now we have the pre-tax earnings. So to that, we're simply going to apply the tax percentage, which in this case is 20%. That will always be given to you. Okay, so now we have the after-tax earnings. With regard to the depreciation of the machine, that's where always has been a lot of confusion about during class. So the important thing is that you show what the tax consequences are. And I'm assuming in this example that the tax consequences are that you depreciate without residual value, and then if you sell the machine, that's when you recognize the tax revenue. However, Gloria also permitted during class that you just deduct the depreciation having into account the residual value. So the depreciation would be 90 minus 10 divided by 3. So that would be an alternative way to calculate it. So that would be negative, right? But the important thing is to be consistent here, okay? However, personally, I prefer to do it like this. Good. So now we already have the accounting numbers and we have the after-tax earnings. What we're gonna do next is to see which of these numbers don't correspond to actual cash flows, and then correct that. So the first thing we know, which doesn't correspond to cash flows, is the depreciation. So always reverse depreciation, because that's not cash flow. So if it's not the depreciation, what happened with the machine, then what happened? Well, in the beginning, at the beginning of the project, we paid 90 for it, right? And then at the end, we received 10, but the 10 is already reflected. So we don't need to adjust more. This is the only thing we have to do. What else do we have to adjust? Well, maybe of the revenue we've been accounted, not everything has been paid, or not everything has been collected, and the same for the cost of goods sold. Maybe we have paid less to our supplier, or we have paid more, but it's still in inventory. So let's see how we have to calculate that. So first, we have to calculate the impact of the working capital changes. We need to know what the working capital is. So let's start with that. This is important to understand. So try to understand the logic of it. Let's see here, accounts receivable. It says that it has a rotation of 180 days. So that means that last half year of my sales has not been paid or has not been collected. So that means an easy way to calculate this is, or actually the only way, is you take the revenue, you multiply it by the days. Wait, I'm gonna fix the column, and then you divide it by 365. Right, so we see that actually half of the revenue hasn't been collected, and we copy that for the next years. In inventory, is the same principle, but of course for cost of goods sold. So we multiply that by the days, and we divide it by 365. Let me fix again the column so I can copy it. We will worry later about the sign, okay? And then for the accounts payable, the same. We take the cost of goods sold, we multiply it by the days, and we divide it by 365. There you go. So this is the working capital, right? But we're not interested here in the working capital. We're interested in how the working capital affects the cash flows. So let's think for a moment here. If I have accounts receivable, that means that my customers haven't paid. So that means I received less cash. So the higher the accounts receivable, the less cash I receive. So that's why we're gonna show it as a negative sign. Let's do the same reasoning for inventory. The more inventory I have, the more I have paid for. So the higher the inventory, the less cash I have. So that has to be negative. And for accounts payable, the more accounts payable I have, the less I have paid my suppliers. So the more accounts payable, the more cash I have. So this is supposed to be positive. So that was already good. So effectively, you can see accounts receivable and inventory, which are assets, have to be negative. And accounts payable, which are liabilities, have to be positive. And that's the other way around than the actual working capital, because your working capital are accounts receivable, inventory, minus accounts payable. But we are interested here in their impact on the cash flows. So that's why the sign is the other way around here. You see that I put in here 0 and in the closing I put 0, and that's an assumption I'm making here because I'm assuming that we started off with 0 in accounts receivable, inventory, and accounts payable, and the same way I assume that at the end of the project we're gonna liquidate everything. So that depends on your assumptions, whether it is like that or whether it's the other way around. So now we only have to calculate the changes in working capital because that's what's gonna affect our calculation. So I put the current year minus previous year, and I do that for all the years. Okay. So this formula has been linked already. Only here is a small mistake, right? And I'm also gonna sum this one here because it's the cash flows that are occurring at the end of the year, right? Let's see what's wrong here. Okay, that's a mistake of mine. So I'm just adding the closing cash flows with the cash flows of year 3. Okay, so now we have the cash flows, and they're gonna appear here as you can see in the calculation of the net present value. They're gonna appear here. So what is gonna happen next? Okay, I was just having a look at the cash flows. Now we're done with the cash flows. Now we have to calculate the discount rate. Although in the exercises, this has never been combined in one single exercise. Because if we calculate the cash flows, Claudia always gave the WACC, or if we calculated the WACC, the cash flows were always also given. But I wanted to connect the dots, so that's why we're doing it in one single exercise. So the discount rate. Let's first calculate the weight. So say debt is 60 and equity is 40. Then to make my life easy, I chose these numbers. The weight of those numbers, so 60 is of course 60% of the total and 40 is 40% of the total. So we're gonna attribute those same weights to debt and equity. Okay. Okay. So now let's see what the costs of debt and equity are. So the cost of debt is just the cost that your bank will charge you. Let's assume it's 5%. Okay. And now the cost of equity is a bit more complicated. That's where the formula comes in that we saw in class. And also beta. So the formula is the market-free or the risk-free rate plus beta times market rate minus risk-free rate. There you go. So let's remember again what all of these components are. So the risk-free rate is as the name says, the rate at which you can invest without any risk. For example, in treasury bonds. In treasury, yes. I forgot the name of that. The market rate is the rate of all the assets that are present in the market. A proxy that is used for that is often the Standard & Poor's 500. And the market rate minus the risk-free rate is what's called the market premium. Okay. Then we have the famous beta. Let's recall that beta indicates how sensitive an asset is compared to the whole market. So if it's a multiplier. It's like your peer evaluation in human resources. So if your beta is 1, it means that your asset behaves exactly like the market. If your beta is higher than 1, it means it's more sensitive than the market. So if there's a crisis, it falls deeper than the market. But if the economy is doing well, your assets is gonna be doing extremely well. Whereas if your beta is smaller than 1, it means it's less sensitive than the market. For example, think of your breakfast cereal. Whether there's a crisis or an economic boom, you're always going to be eating your cereal. So the producers of breakfast cereal probably have a beta that's smaller than 1. Okay, so we have the weight, we have the cost, but one thing is missing. Remember that the cost of debt can be deducted from tax. So the actual cost is not 5%, but 5% minus the tax benefit. And the tax benefit is 1 minus the tax rate. Okay, so that would be 1 minus this 20%. And by multiplying all of that, that gives us the weighted costs of equity and of debt. And if we sum that, that gives us the WACC, weighted average cost of capital. So that's what we're gonna what we have to fill in here below, to the power of 1, 2, 3 in years 1, 2, 3. And that will give us the net present value of this project. So we see the net present value is positive, which means that in theory it's a good, or it might be a good project to invest in. And that also means that the internal rate of return is higher than the WACC. And then we also saw something called the earn back period. And that simply states in how many years do you earn back your initial investment. So let's see, in year 1 or in year 0, I just spend money in year 1, 2, in year 2 also, and it's only in year 3 that I'm going to be earning back my complete investment. So somewhere in year 3 is the earning back period located. These are the basics of net present value.